Assalamu alaikum. This video introduces the new technique for recording a business combination. We will provide background on how the new rules evolved and what was done before the recent changes. We will talk about acquisition accounting and how to record assets acquired and how the acquiring company will record the payment for acquisition. We will also cover how to record acquisition related expenses, measurement period, and measurement period adjustments. Finally, we will look into a comprehensive illustration on acquisition. But in the beginning of this session, I would like to thank my son Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would also like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use her time in making this video. Let us start with the background for accounting standards for business combinations. Historically, two methods of accounting for business combinations were permitted: purchase of interest and pooling of interest. However, pooling method has been prohibited for business combinations since June 30, 2001. In pooling of interest method, the assets and liabilities were recorded at their carrying amounts in the books of the transferee company. Whereas in purchase method, the assets and liabilities of the acquired company are recorded in the books of acquiring company at their fair market value as on the date of acquisition. On December 2007, FASB, with the objective of having a more comparable and transparent financial statements, announced a change whereby they replaced FASB statement number 141 with statement of financial accounting standards number 141R, according to which they mandated the use of only a single method of accounting for business combinations. They also replaced the term purchase method with acquisition method. In early 2002, FASB and International Accounting Standards Board agreed to have a common standard for both domestic and cross-border combinations. Unfortunately, these standards are not identical yet. In the past, when a business combination was achieved in stages, for example, a company purchased 25% of another company at one date and purchased an additional 20% a number of years later, and then achieves control by purchasing 10% at a later date, companies used to combine all these costs with the current value that reflected a mix of fair value and old book values. Such accumulation lacked consistency, understandability, and usefulness. FASB recommended that the acquired business should be recognized at its fair value on the acquisition date and not its cost. Under the current rules, the fair values of all assets and liabilities on the acquisition date, defined as the date the acquirer obtains control of the acquiree, are reflected in the financial statements. Yet another amendment was made on December 4, 2007, whereby Accounting Research Bulletin number 51 was replaced by Accounting Standard Codification 810. It establishes standards for the reporting of the non-controlling interest when the acquirer obtains control without purchasing 100% of the equity. Let us now talk about changes in GAAP and ASC, Accounting Standard Codification. Previously, measurement date for securities issued used a reasonable period of time before and after the terms are agreed to and announced. Now, the measurement date for securities issued use the fair value on the acquisition date. Previously, acquisition cost was capitalized, while now acquisition cost is expensed. In the past, in case of acquisition less than 100%, minority interest was recorded at historical cost, while now the non-controlling interest is recorded at fair value along with 100% of the goodwill. In the past, research and development was included as part of purchase price, but then immediately expensed. However, now research and development is included as part of the purchase price and treated as an asset. In case of negative goodwill in the past, non-current assets were reduced, but now no reduction of assets is recorded. In the past, contingent considerations was recorded when determinable and reflected subsequent changes in the purchase price. As per the current GAAP, contingent considerations is recorded at fair value on the acquisition date with subsequent changes recorded on the income statement. In the past, business was defined as a self-sustaining integrated set of activities and assets conducted and managed for the purpose of providing a return on investors. Now, business is defined as a group of assets consisting of inputs and processes with the ability to produce outputs and as being conducted for the purpose of providing a return to its owners, members, or participants. In the past, decrease in ownership interest included gains and losses in income. Now, decreases in ownership accompanied by a loss of control result in a gain or loss. Let us now talk about acquisition accounting. Acquisition method treats the combination as the acquisition of one or more companies by another. Accounting for business combination involves 4 steps: identifying the acquirer, determining the acquisition date, measuring the fair value of the acquiree, and measuring and recognizing the assets acquired and liabilities assumed. The acquiring company can acquire the assets of the acquired company at a fair value. Now the question arises whether the assets acquired be recorded at fair value of the stock issued or fair value of the net assets acquired. If the stock issued is actively traded, then it is a better evidence of fair value and the assets acquired should be recorded at the fair value of the stock after taking into account market fluctuations, issue cost, etc. If the stock issued by the acquiring company are new or of a closely held company, then it is better to record the assets acquired at the fair value of the net assets. The acquiring company can pay more than the fair value of the identifiable net assets or less than the fair value of the identifiable net assets. If the company pay more than the identifiable assets acquired, including intangibles other than goodwill and liabilities, then the excess amount paid will be recorded as goodwill, as FASB is of the opinion that goodwill cannot be measured directly and is the balancing amount. Please also note that should not be amortized but should be impaired. We will talk about goodwill impairment in the next video. The acquiring company may bargain and pay less than the identifiable net assets. If acquisition takes place by bargain, then such gain must be recognized to balance the accounts. Once the gain is determined, it is recorded as bargain purchase gain. Let us talk more about bargain purchase. If acquisition takes place by bargaining, then such gain must be recognized to balance the amounts. Once the gain is determined, it is recorded as bargain purchase gain. FASB guidelines in this regard are: any previously recorded goodwill on the seller's book is eliminated and no new goodwill is recorded. A gain is reflected in the current earnings of the acquiring. Let us take an example on bargain purchase. Perpetual Technology Company pay 15,000 cash for all the net assets of Speedway Technology Company. The book values and fair values of Speedway Technology Company balance sheet items for the year 2021 are as follows. We have the book value and we have the fair value. So don't forget that business can be acquired at fair value only. So assets will be recorded at fair value, while the liabilities will be recorded at fair value. And in this case, you can see that the net assets fair value is 18,000, while the price paid is 15,000, which is less than the fair value of net assets acquired, that is 18,000. So current assets are debit, building is debit, land is debit, liabilities are credit, and cash that we have paid is credit, while there is a gain on acquisition of 3,000. Let us now talk about treatment of acquisition related expenses. FASB has excluded the acquisition related cost from the measurement of the consideration paid, as such costs are not part of the fair value of the acquiry and are not assets. Both direct and indirect costs are expensed, and the cost of issuing securities is also excluded from the consideration and accounted for separately from the business combination accounting. Direct expenses incurred in the combination include finder's fees, advisory, legal, accounting, and other professional or consulting fees. Indirect expenses are the ongoing cost and include the cost to maintain a merger and acquisition department, general administrative cost such as managerial or secretarial time, etc. Let us look into an example in this regard. Perpetual Technology Company acquires 100% of the net assets worth 150,000 of Speedway Technology Company by issuing common stock with a fair value of 170,000. Perpetual Technology Company incurred the following cost. So these are the cost, and all the costs are going to be expensed. So professional fees expense will be debit by 2,000. Merger department expense, that is indirect, this will be debited by 4,000, and other contributed capital security issue cost will be debited by 5,000, and cash will be credited by 11,000. Let us now talk about measurement period and measurement period adjustments. Measurement period is the period after the acquisition date during which the acquirer may adjust the provisional amounts recognized at the acquisition date. The acquiring company may have recorded the identifiable net assets at an estimated fair value. Estimated figures are referred as provisional amounts. The measurement period cannot exceed more than 1 year from the date of acquisition. During this period of 1 year, the acquiring company can obtain the required information to identify and measure any of the following information: identifiable assets acquired, liabilities assumed, and any non-controlling interest. If the business is acquired in stages, any previously equity interest held by the acquirer, any considerations transferred to the acquiree, amount recognized as goodwill or gain from a bargain purchase. The increase or decrease in the provisional amounts are adjusted by increasing or decreasing the amount of goodwill. Once the acquisition period is over, the acquirer can only revise only to correct an error. Finally, let us do a comprehensive example on acquisition. On January 1, 2021, P Company in a merger acquired the assets and assumed the liabilities of S Company. P Company gave one of its 25 par value common share to former stockholders of S Company for every 2 shares of the 10 par value common stock they held. P Company common stock, which was selling at a range of 55 to 60 per share during an extended period prior to the combination, is considered to have a fair value of 50 after an appropriate reduction is made in its market value for additional shares issues and for issue cost. We are required to make the necessary general entries. So this is the balance sheet. You see we have the book value of the parent company and we have the book value and fair value of the subsidiary company. We have the assets and the liabilities, and we have to make necessary journal entries in the books of S Company to record exchange of the stock for the net assets of S Company. And we have to prepare the balance sheet of P Company after acquisition as on January 1, 2021. So this is the information that is already there in the problem or the illustration. And don't forget that we have to acquire business at the fair value and not at the book value. So when we are acquiring, we acquire cash and receivables. So cash is debit and receivables are debit. Inventories are debit for the fair value. Land is debit and building and equipment is debit. Then bonds payable are recorded at the fair value by recognizing a premium or discount on the bonds. In this case, obviously it is a discount. You can see that the bonds payable book value is 500 and the fair value is 400. The sum of common stock and other contributed capital, you can see in this case, you see they are issuing 2 shares, 1 share in exchange of every 2 shares. So the number of shares is 30,000 and the par value of the parent company was 25. The market value was 50. So the balance other contributed capital is 30,000 times 25, that gives us 750 and 750. So the sum of common stock and other contributed capital is 1,500,000, while the fair value of the net assets will be the total of the assets, that is 1,845,000, and the net value of the liabilities, it is 160 plus 500 and minus the discount on the bonds payable, that is 560,000. So the fair value of the net assets will be 1,285, that is now. So the common stock is credited for the par value of the shares issued, with the remainder credited to the other contributed capital. Individual assets acquired and the liabilities assumed are recorded at their fair values. Plant assets are recorded at their fair value in their current depreciation state. After all assets and liabilities have been recorded at their fair value, an excess, you can see in this case we make the total of our liabilities and common stock, and we make a total of our assets including the bonds payable. We get the net value of 215,000, and this is the amount of goodwill. When we prepare the balance sheet, we simply sum up the book value of the parent company and the fair value of the subsidiary. So the cash and receivables 240 plus 170 is 410. In the same way, we'll be adding up all the assets and we will be having the goodwill that we have just now calculated. $215. Bonds payable was 500, that was the book value, but then there is the fair value is 400, so the balancing figure was the bond discount. We record the number of shares as 80. Remember, 50,000 were for the parent company and half of these have already been issued by the parent company. They have purchased in the ratio of 1:2. Other contributed capital is 1,100,000. Stockholders' equity is total of the stockholder equity is that common stock plus other contributed capital plus retained earning, and you can see that the total of assets is equal to the total of liabilities. So this completes this session on accounting for business combinations. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any questions regarding this session, then please don't hesitate to ask in the comment box or by an email, and inshallah I will reply you back.